Good afternoon, ladies and gentlemen. It is June 3rd. The market is closed. It's a Tuesday. In last market brief, we talked about a bunch of different ETFs to watch to maybe generate some trade ideas. And we discussed how we might see some rotations into small caps. For example, IWM right here started breaking this trend line. We'll see if this is the start of something bigger or potentially just a fake out. On today's stock market brief show, where we navigate the financial markets through the lens of technical and intermarket analysis, we're going to be diving into some critical levels that are just overhead for the S&P 500, and then also introduce, once again, some interesting correlations taking place in the market to continue to watch. On top of that, we'll go over the updated expected moves and market conditions. For those that don't understand, this section is so incredibly important to understand because it helps you define what strategy works best in what environment. We're going to go over in some signal charts and re-hop into crypto as well. So we got a lot on deck. Let's go ahead and get into today's show. Welcome back to the show, everybody. The Nasdaq composite you're seeing here on the daily time frame highlighting the V bounce recovery that we've seen not too far, right? A stone's throw away from all-time highs. And this rockin' rally over here has really had not much pullbacks at all and very little consolidation. Some might call this kind of a lockout rally, whereas if you kept on seeing it kind of run away, it probably just got angrier and angrier. Down here, we were talking about how this was the pain trade to potentially see the market move back to year-to-date highs and a prior year-to-date closing price, and that was that lockout. Then up in here, we started saying that the next pain trade is probably going to be the shakeout, where we get some crazy movements back and forth, and then potentially a pop higher drop, and just shake people out, get the whole narratives very confused. Well, on today's episode, we are starting to kind of continue this upwards momentum. There's a lot of positive-looking setups, but you got to be aware of what's overhead. Now, when we start to see, I like to look at what's called relative strength charts, and more specifically, I like to watch risk ratios because it allows me to really things can be turning as well. So for example, when we were moving higher here into this area, the risk ratios that I like to look at were actually heading down, right? Go figure. Risk off ratios are underperforming the S&P 500, and I'm talking about gold, utilities, consumer staples, TLT, healthcare, and defensive names. It's all there in the red, trending lower. And then when you start to see a subtle shift, when they start to turn up like this, it's just telling you that these assets are outperforming the broader market. And that happened to be during this time here. And as we started to kind of find a bottom in here where we started to look for follow-through days, when we start to really watch for specific pullbacks and measure out key levels, that's when we started to see this start to fade once again. And that right there tells us what? If risk off ratios are going down, it means that the markets are more risk on. So as it stands now, what are the ratios telling us? Well, they're rather flat to trending down still at this point, which makes sense. If you take a look at the 11 sectors that make up the S&P 500, tech led the way, and then energy not too far behind. And that one I want to hop into momentarily because that is going to be an important one to watch. It has implications on the overall market when you see the energy sector outperform the S&P 500. And I'm not just saying that to say it. I'm going to prove it to you on today's video. Tech was the leading sector. So what drove tech today? It happened to be renewable energy equipment and the bigger dog, semiconductors. Now, I do find this interesting because even though we had tech up on the day, it was semiconductors and renewable energy led the way. So when you look at something like MAGS, which is the Magnificent 7 ETF, you can see that this was only up 0.25% on the day, kind of underperforming overall, has a little bit of that negative divergence with this crossing over here too as well. And like I said earlier on the prior video, we are actually outside of the quarterly expected move. So it's above expectations for the market. And when we break from these levels, you can see significant pushes higher, perhaps to the month to date. But I just want people to be aware that it's also likely when you get down here, which we did well under the expected move for the quarter, these are typically areas where I like to start buying into my longer term accounts when it does occur. And then sometimes we get some nice recoveries from that point. So now we're just on the flip side to that. So I've been looking only at the positions that are providing strength, that are tightening up, that are looking like pause, like they can break out and potentially go continue on. And that really hasn't been too much in the Mag 7 stocks. Okay, if we hop over here to the Tesla chart, there was a potential reason why the mags and the Qs sold off intraday. Happened to be a tweet here from Elon Musk about the spending bill, and as soon as that kind of hit the tape and Tesla sunk off like a rocket ship, we saw a little bit of recovery but move lower, and that's could have what drove the Qs and obviously some of the Mag 7 stocks, what caused some of the order flow to continue on that sell side trajectory. If you look at the Qs, they finished up 78 basis points today. I know people are going to start calling out the negative divergence here that's forming, right? Price action's going higher, and you have the RSI. It's not oversold conditions yet, and this divergence can simply be broken by putting in a higher high than this one. But as it stands right now, I would consider this a divergence that is building. It's not necessarily actionable right now, but it is something to note on the daily time frame. And note too as well, the price momentum oscillator is starting to slow down here as prices really just pranking this trend line, which I will tell you, this trend line, it's not going to hold forever. I guarantee you this trend right here is too steep to hold forever, and it will break at some point, which will probably result in a longer drawn out type consolidation, a little bit of a pullback, more shakeouts, and so forth. If we take a look at the SPY here, SPY continues to trek upwards, breaking out here, and some people will probably call this a little divergence that's currently building, right? Being that it's building, it hasn't been confirmed. So take it for what it is, but we're holding up and trying to break out of this kind of pivot right here as it stands. If you look at the weekly time frame, we're still above a inclining weekly 5 EMA, and we have yet to tag about it. If we keep on cranking up higher, it's going to bring this up to make it look like we tagged either this week and or the following week as a possibility. Remember, when you don't tag it for multiple weeks, there's going to come a tag at some point, right? That's just what happens. It's the most frequently tagged EMA here. And there's very few times in history where you go 3+ weeks without reconnecting with that EMA. Now, there's two big assets that I like to watch for intermarket analysis, and that's really the dollar and the 10-year yield, or yields, the bond market, right? There's other things that I like to look at, but those are the bigger ones that a lot of people keep their eyes on. And we've been seeing some interesting correlations take place. One, we've had a strong correlation between the dollar and the 10-year yield, as you can see here, but up until Liberation Day, there happened to be some sort of a break in that correlation, which is just telling me maybe we should pay more attention specifically to what the dollar's correlated to specifically on multiple time frames and various assets, and then what the 10-year yield is correlated to. Now, when it comes to the dollar, there's not really all too strong of correlations right now, so I'm not bringing that chart up, other than like something like gold, right? There's a pretty strong negative correlation there. But the 10-year yield is one to watch for, and what can move before the 10-year yield? How can we get a head start on that? And that is what we discussed on the prior episode and multiple other, and that happens to be oil. When oil makes a sudden shift, the 10-year yield can likely follow there shortly after. In fact, we were talking about how oil was tightening up and how it looked like it has the potential for a breakout. It did pop higher, and what did the 10-year yield do since that point? It moved slightly higher. It started low today, but closed at the highs, and it's still within this kind of compression pattern. So if oil is going to continue to rise here, this is going to be one of those important reasons why I said keep a close eye on energy stocks. I'll show you more as to why. But that also could mean that the 10-year yield can bounce up, right? 4.5 to 4.55, maybe back even to test this high. I don't know how high it can go, but that is going to be an important one to really monitor. You can see crude oil here too was tightening up, and we're seeing a little bit of a breakout. Is this breakout going to lead to further move higher? And if so, potentially where, right? Well, perhaps right into and around this 66, 68 kind of range in here, where we saw prior kind of resistance broken, and then we flush back down. So this level in here can be an interesting level. Now, if oil starts to move higher, right, that can bring yields up, which we previously discussed. That's a possibility, which would mean what? It would mean that bonds kind of come back in a little bit as they've been in a bearish trend overall and underperforming the S&P 500, as you can see there. But if that is going to be the case, I want you to pay attention to some correlations, right? Like we just said, the oil, right, is right here. It's correlated to the 10-year yield. It has a pretty strong correlation from a 20-day perspective. It's at 0.75. Now, if I look at XLE, what is XLE's correlation to oil? Well, it's also positive here at 0.75. What does that mean? It means that if oil does actually break higher, that means yields can go higher. And that also means the energy sector can go higher. And you could see, even if you look at the 10-year yield, right, and energy, these are just stacked on top of each other. They kind of move hand in hand here, right? So there's a lot of strong correlations and relationships right here with knowing and understanding oil. Now, why is that important? It's this chart, and I show this multiple times. This right here is energy relative to the S&P 500, meaning that when the line goes up, energy is outperforming the S&P 500. Okay, you can see it was up slightly today. Now, remember, energy can go up, and S&P 500 could go up too faster, and that would still drive this line down. That's a possibility. It's when energy continues to outperform the S&P 500, what happens to the S&P 500? Well, green line go up, S&P 500 go down, green line go up, S&P 500 go down, green line go up, S&P 500 go down, and so forth. Boom, boom, boom. Okay. Now, what do you see here? When this line goes down, meaning the S&P 500 is doing better than energy, well, we actually see the S&P 500, it likes that. It likes when it underperforms, energy that is. So my thought is simple. If all of a sudden oil starts to take off, in not all, it doesn't even have to be huge, but maybe in the meantime, if oil starts moving higher, the 10-year yield could start moving higher. If this line starts pressing higher here, it's kind of in this compression pattern here, that can stall out the S&P 500 and potentially even pull it back a little bit, resulting in some sort of a shakeout in the month of perhaps June. And that could come from the bigger tech names, but also you got to pay attention to where people might rotate into, which we kind of saw today. We're seeing some smaller tech names start to perform. We saw a rush into some smaller cap names. And that's why I really went over on the prior video, if you haven't seen it, those ETFs to watch to kind of generate some trade ideas and get your mind thinking about some other areas to look, which, by the way, they were all up the day after that I posted that, and the following day, again, doing quite well. Okay, if we take a look at the dollar was slightly up today, and that drove the price of gold down. Gold was up prior on this down day, so that has that negative correlation, but this one could be one to watch. Overall, it's kind of just going sideways. It got very extended to the downside here, and we bounced into an area of prior resistance. That resistance held, and we kind of came back in here, putting in this little reversal candle. So if the dollar wants to bounce up back into this area, I'd say, yeah, be aware of its correlations. The one that stands out to me the most is gold, and I would think that gold would consolidate more, come back in if we have a dollar that starts to rise here. At least that's the current correlation. Now, let's talk about the expected moves, because this is going to tell us where the market could potentially go to and kind of get held up at. As the momentum continues on, I'm paying very close attention to 604.83 on SPY and 614. So this kind of range in here is going to be critical. In fact, it's just a little bit lower. I'd say even right at that upper weekly expected move. So this area here is going to be, in my opinion, in the near term at least, hard to overcome. And I'll talk why that is in the market conditions section. So first and foremost, a lot of people say, well, is it going to go up? Is it going to go down? Oh, like people want their hand held. But to conclude on this, what am I trying to tell you? The market's going up. So what? Right? You look for positive setups in the market, things that are tightening up, like the ETFs that we talked about on the prior day, or various stocks in there. You add exposure, and while the market's pressing higher because of the current market doesn't consist, which we'll talk about, you typically will sell some, and then you'll look to buy back on dips, and we'll continue that kind of path. Now, if I look at what happened intraday today, I like to use the daily expected moves, and as we're coming right into the daily expected move, we started rejecting from that area. It happened to be right when Elon tweeted there too as well, and we kind of bounced in and around there, not too far from that upper weekly implied move. Tomorrow's session, if we start to get some continuation through this move, the upper daily implied move would bring us into and around the upper weekly implied move. So in and around this area to the upside. To the downside, you got about 592.34 to 589, and that would be pulling us back into and around the week to date anchored volume weighted average price and an inclining 5-day moving average. So we got a lot of confluence in here. And even so, if you were to pull back, I mean, would just potentially be a pullback in a upsloping shorter term average. So overall, shorter term is bullish. The medium term is more bullish here. It's a pretty bullish market overall. So now we got to be mindful of where things can get heated. Now, if you want the daily implied moves for some other assets, this is something that I share in the Discord community. So I'll share it with you today. Screenshot it if you want the levels for ES, NQ, Ready, SPY, Q, IWM. This is the daily expected move. That's plus or minus. You have your upper levels and lower levels, and I even include the 2 standard deviation levels right there. So screenshot that. If you want the MAG 7 daily implied moves, this is based off of just my calculation. I call it the IVOL range. It's the implied volatility range for these specific assets. These are the expected moves. You got your upper lower levels and your 2 standard deviation levels there. If you want to know more about expected moves, I do have a video on it, how I pull them, and then also I kind of walk you more through of how I think in terms of probabilities for these specific levels. A lot of times people think that they're areas of resistance, areas of support. That's not necessarily the truth, although it can look like that when price comes to these levels, but it's more about probabilities in the market. Okay, let's go into market conditions. Now, this is a critical level, and the one that I wanted to kind of call out here as to why I think that we got to be aware of things overhead where, yeah, the momentum's pressing up higher, but I don't really think that we're going much further through 6,000, at least in the near term, until we have a bigger OPEX or start to see traders reach out significantly higher. Now, the reason why I say that is because this level is the net gamma level, the call wall in net gamma, and that's 6,000. So for price to come up to 6,000, maybe push through it, doodle around within this area, maybe get rejected from it and come back down to a key level, that I think is more likely than anything right now in the near term. Now, if this all of a sudden shifts down because these shift way up and we start seeing traders reach out further, okay, my narrative there would shift. But as it stands right now, 6,000 is that call wall. And when price gets to these levels, it can kind of act as a pinning mechanism and kind of get held up there. So if I want to add in a couple of levels here, if I'm looking at SPX 6,000 level is right here, and price action is legitimately right there. Okay, so we're not too far from that 6,000 level. So if we start breaking from it, be aware that it can act as a pin and pull price back in. But if we start moving through this, the upper quarterly expected move for SPX is at 6106. So 6,100, and then right above there's the upper monthly at 6162. So back again to the S&P 500. This area for the remainder of the month, remainder of the quarter, I think that we're kind of going to get held up within and around this range if momentum continues up. Another level to watch is the JPM short call. This is part of their collar. And you can see that when we got up into here, what did we do? We doodled around, came in. So to even come back in through to here, that's more than likely to happen. Now, as we break from it, you can have dynamic hedging kick in and get a little bit more of a gamma squeeze through. But as it stands right now, we're kind of in that area where, hey, start to look at areas, once again, where people may rotate into. And right now, what I've saw today and what I prepared for in the month of June is maybe some of the more smaller cap names, high short interest names, where people start to look to quickly move and you get some quick, nice moves. And maybe the S&P 500 crawls up higher, but it might do so at a slower rate. And we can get held up very easily at the call wall or these upper quarterly levels. That's what I'm thinking here. So in short, I'm bullish, right? But I'm only trading the stuff that makes sense from a risk to reward standpoint. The 5-day moving average is all inclining here on SPY, Qs, IWM, semiconductors, biotech, and DI. So that's a positive sign here. We're above the 5-day moving averages. We're above the gamma flip line, albeit we're not too far from the gamma flip line. For those who don't understand what the gamma flip line is, I'll revisit that again, right? When we're above it, right? The strategy that I like to more focus on is swing trading, right? SW. When we're below it, I like to focus more on day trading. That means, just intraday or shorter term. Okay. And the reason, simply put, is because market dynamics shifts when we are above and below this gamma flip line, which is dynamic and it changes. But when we're below it, volatility tends to increase. When we're above it, volatility tends to decrease, which we have been seeing since we got back above that gamma flip line. Now, another aspect I like to look at in volatility land is looking at back month versus front month volatility. And when we get up into around 20% here, which is 1.2, it just tells us that back month volatility is 20% higher than front month. When you get up here, it's typically common to see consolidations, little pullbacks in the market, and so forth. Just like if you get way down here, we start to look for bounces to take place in the market, and we're not too far from that level. So if the S&P 500 wants to press on, be aware of the call wall and the upper expectations that the market priced in and now being extended up here. Because what happens in these times, when the S&P 500 all of a sudden breaks out of a tight consolidation, right? Where's the S&P 500? Boom, breaks out of a tight consolidation. People get super pumped. It's going to all-time highs, and it very well may. But guess what? If they're not aware of those critical levels, if they're not aware of the call wall, if they're not paying attention, there's like probabilities where you get bigger shakeouts, pullbacks, and maybe longer consolidation. So it's always important, once again, to watch where things rotate into and to make sure that when you trade, it makes sense from a risk to reward standpoint, because you're not going to control how high it goes, but you can control what you buy, when you buy it, how much of it you buy, and when you sell it. Alrighty, let's get into some of the signal charts now. It's a couple divergences that are building between equal weight and the S&P 500 cap weight. You can see S&P 500 drove higher, but yet equal weight has not, albeit that this will break the divergence. If this breaks through that, that would look good right there. You can see the last time we had that bigger divergence, we put in lower highs, higher highs, and it led to the market selling. In short, what does this mean? It means that internals are weakening from a equal weighted perspective, but fewer names in the cap weighted are actually driving the market higher, which can be a bad thing. You can also look at the value line geometric index here, right? It was actually down today and the market was higher, which I found to be kind of interesting. And this one is, right, flagging out. I keep on pressing buttons. This one is flagging out still. So, hey, we can maybe break this higher and that'd be a positive sign, seeing some breadth enter into the market. Okay, cool. But right now there is a divergence that is currently building out, and we've seen this throughout history. Divergence, sold off. Divergence, right? This one sold off. Little sell off. Okay, this bigger divergence, boom, larger sell off. Divergence, boom, pretty sharp sell off right there too. Okay. All right, we'll continue on. This here is the Nasdaq summation index, and this down here is the Nasdaq McClellan oscillator. And what I like to do here is put a parabolic SAR on the summation index and kind of hone in on potential changes in trends. And just recently, you can see here that we had the parabolic SAR uptick through that, and that could potentially mark a change in trend. It did, you know, the more recent one that you really played out well was right here, and it led to some more selling over here. We saw a couple whipsaws right here that led to more selling, and then we actually had a change right here, which led to a nice rally in the Nasdaq composite. So I think it's worth noting that that's the case. And as the market's pressing higher, we're not really getting all too much breadth. We've been seeing some negative readings, but it just went positive today. So I think that that's worth noting, that the market's pressing higher, but we're seeing sudden shifts here. Not necessarily a tradable signal as it stands, but it is noteworthy that the summation index did have a subtle shift here. So if the market keeps pressing higher, maybe perhaps we can reach back up and see this change. But as it stands now, that is telling us to proceed a little bit slower and with some more caution. The bullish percent chart for the S&P 500, we got extended RSI, right? We came in and we've been just consolidating. It's below 70, but it's kind of just doodling sideways as it stands. If this comes back up, right, and creates some sort of a negative divergence here, that right there would be our signal to be a lot more cautious. But right now, I just wanted to give a quick update because we haven't talked about this chart in a minute. The housing market also kind of interesting here. This one also is not confirming the move in the S&P 500. In fact, it didn't move at all with this rally, and they have a strong correlation. So what I like to do is look for divergences that happen, right? You have matching highs here in the housing market. S&P 500 went higher. That's a divergence, right? So what's it telling you? The housing index is not confirming this move, and it led us to some sell side. We had a bullish divergence here where we had a higher high, and that led to a nice market rally. And then more recently, we had this negative divergence here, and that led to some sell side there as well. And what I'm calling out right now is you have price action pulling down while S&P 500 just went higher. Is this telling us another story, or is this just tightening up, flagging out, and are we going to actually finally see the housing market start to catch up? I think that that'd be something interesting to watch, but it's also important to continue to watch, like I said, the yields, because if the yields rise, that can obviously put pressure on the housing market, as there's typically a negative correlation there. All right, so we'll go ahead and then continue on into the crypto space, give you the update on the sailor to shift tool. It is coming near that flip line over here, but it's not quite there yet. It was there the other day, but we need the week to close down beneath it, and then we need the week to hit, the following week to hit the low, break the low of the prior week, and that would be the confirming signal. So right now, price action is what? Pulling back, and it's consolidating, and we don't have the confirmed signal or trigger yet. And this made a big shift in this because gold the other day saw a nice big rally. Today, it pulled back in a little bit, giving back about 80 basis points. Silver saw a nice break from this tight pattern. It did look bullish, but to me, overall, it's still kind of in this range bound. And I was getting ready to see if it were to break down, I would be looking to short the miners. I did take a short here at the closing bell of this big, huge up day. It was a monster up day. It was kind of a no-brainer fade for me, and I'm already out of that position for just a quick couple percent there. I think I used, for those that are interested in a specific ticker, dust. And if you don't believe me, I mean, I can share it on Twitter. Just tag me and I'll show the trade itself. Okay, then silver, right, just down slightly on the day, consolidating. These have a strong correlation, so continue to watch that. Figured I'd just update you on that one. And then here's Bitcoin, right? Saw a little bit of an uptick, still above the inclining 50 EMA on the relative strength line. Still continuing to watch to see what happens in the sailor to shift tool. But as it stands right now, look for various equities, look for these to potentially move higher or continue its trend. And then I'm more cautious when we're obviously below it. Some people like to front run this stuff. I don't, right? So I'll take a position in Bitcoin. I'll take a position in Ethereum, right? I think that these charts look pretty good from an absolute perspective, and my signal's still confirming. So until that changes, right, I won't proceed. But right now, like Ethereum's kind of flagging out over here after a pretty big breakout. The EMA, right? The 50 EMA on the relative strength line is still trending up. So it's a positive sign. What would be bearish? Well, if we got the bearish signal on my sailor shift tool and this broke down, and I'd be like, okay, I'm no longer interested. I don't care about being right or wrong, but the goal that I go for here is I look for the tight contraction. I want to play the expansion, which means what? It means I want to make the most amount of money or the most amount of return in the shortest amount of time and risk as little as possible. That's what I do. That's all I got for you on today's episode, everybody. It was a lot that I discussed. Hope it helps out, gives you some insight into what it is that I'm seeing. I'll see you on the next.